Real estate professionals must help buyers understand that mortgage rates are not one size fits all. Many variables influence the rate a borrower receives, including individual financial factors, broader economic forces, and the specific loan program selected. Being able to explain these elements with clarity, while staying within the boundaries of real estate licensure, is both a professional responsibility and a service to your client. Borrower-specific factors that influence mortgage rates. These factors are directly tied to the buyer's financial profile and are evaluated by lenders to determine the level of risk. 1. Credit score. Borrowers with higher credit scores generally receive lower interest rates. Credit score acts as a key indicator of a borrower's likelihood to repay. Under ARS, paragraph 32-2153b3, real estate licensees must not misrepresent material facts. This includes suggesting a buyer qualifies for a lower rate than their credit actually allows. 2. Down payment, loan-to-value, LTV ratio. A larger down payment reduces the LTV ratio, which typically improves loan terms and interest rates. Lower LTV means less risk for the lender, often resulting in more favorable pricing. 3. Debt-to-income, DTI ratio. A high DTI signals a potential inability to manage monthly payments. Borrowers with high DTI may face higher rates or even loan denial. 4. Employment and income stability. Stable employment history and consistent income provide confidence to lenders. Self-employed or freelance borrowers may undergo stricter documentation requirements. 5. Loan amount and term. Larger loan amounts, especially jumbo loans, or longer terms often come with higher risk and less favorable pricing. These loans may have stricter underwriting guidelines and fewer investors. Market and economic factors that influence rates. These elements are beyond the borrower's control and shift frequently in response to national and global financial indicators. 1. Federal Reserve policy. The Fed does not directly set mortgage rates, but influences them through its target for the federal funds rate. Mortgage rates typically rise or fall in response to Fed actions. 2. Inflation trends. As inflation rises, mortgage rates tend to increase to preserve lender returns. Mortgage rates often reflect inflation expectations over time. 3. Bond market and mortgage-backed securities, MBS. Mortgage rates are linked to the performance of 10-year Treasury yields and MBS pricing. Strong demand for MBS, lower rates, weak demand, higher rates. 4. Economic indicators. Employment reports, GDP growth, and housing starts can signal strength or weakness in the economy. Strong data usually pushes rates up, weak data often brings rates down. Loan product and structural factors. The type of loan selected also directly impacts the mortgage rate offered. 1. Fixed versus adjustable rate mortgages, ARM. Fixed-rate loans offer consistency over the life of the loan. ARMs may start with a lower rate but fluctuate based on market conditions. 2. Conventional versus government-backed loans. FHA, VA, and USDA loans may offer lower initial rates, but often include additional fees or insurance requirements. Conventional loans may be more favorable for buyers with strong credit and down payments. 3. Discount points and fees. Buyers may opt to buy down the rate by paying discount points at closing. 1 point. 1% of the loan amount and can reduce the rate by 0.25%, 0.375%, depending on the market. Under AAC R4 28-1101F, agents must avoid giving specific loan or rate advice unless they are licensed as mortgage professionals. Instead, they should refer clients to qualified lenders. Helping clients understand rate offers. Real estate professionals should be prepared to guide clients through rate comparisons and explain the general structure of loan terms, without offering personalized financial advice. 1. Break down the loan estimate, LE. Help buyers understand the difference between the interest rate and APR. Identify lender credits, discount points, and total costs. 2. Compare multiple offers. Buyers should shop for lenders, not just rates, but fees, terms, and reputability. The total cost over time is often more important than just the rate. 3. Set realistic expectations. Based on buyer credit, DTI, and LTV, explain that rate offers are customized. Reinforce that their rate may vary from what they see advertised online. According to AAC R4-28-1101A, agents must act in their client's best interest and deal honestly. Setting accurate expectations about financing is part of this duty. Empowering buyers without overstepping the licensee role. While real estate agents do not originate loans, they play a critical role in educating and guiding buyers through what affects rates and how to make informed decisions. Referring clients to trustworthy mortgage professionals, staying within the scope of licensure, and disclosing what may materially impact the client's financing are all required under Arizona law.